When it comes to GDP, one tough thing to do is actually to measure it. How do we measure the flow of an entire economy's production during a year? There are really two ways to measure GDP, the income approach and the expenditure approach. In this video, we're going to cover the expenditure approach. The basic idea is we're going to look at the economy's overall expenditures, different areas where money is being spent, to try to estimate how much production has happened in all of those areas within our economy so we can get this overall total measure of our production. The expenditures approach really has four components. First, we're going to measure consumption or personal consumption, investment or gross private domestic investment, government expenditures, so government consumption and investment, and then finally, net exports to foreigners. The first topic is personal consumption. This is the household spending on consumer goods and services. These are all counted when they are purchased. So if you go off and you buy a movie, or you go out to the movies or something like that, that is going to be personal consumption. Or if you go out to eat and you're basically paying for some food and some services. So you're paying your waitress and for them to cook and prepare your food. This is all personal consumption. So this gets captured into that consumption category of the expenditure approach to calculating GDP. Next up is investment or gross private investment. Investment can be defined as the production of capital goods, goods that are used for producing other goods. So from macroeconomics, from that point of view, investment does not mean kind of the layman's view of investment. So the average person's notion of investment is this kind of financial investment. So the purchase of stocks or shares or mutual funds or any other kind of financial asset. This is usually what we think of when we think of investments. This is not the macroeconomic definition of investment. So in economic analysis, investment means the addition to our stock of capital goods, such as buildings, equipment, inventory, things like that. So if we're adding to that stock of capital goods, that is investment, right? If we're adding equipment or adding inventory that adds to our future productive capacity, that is investment. So investment here in this case, gross private investment, this counts replacements to machinery and additions to our capital stock. Additions to inventory are counted. Depreciation is not counted as a negative towards GDP. Again, we're not looking at the stock of GDP. How much total output have we ever done? We're looking at the flow. What has been produced this year? And so additions to inventory are counted because we're seeing that flow in, whereas depreciation is not counted as a negative towards GDP because we're just simply trying to measure how much more can we put in or how much more can we flow into our overall stock. What's moving in? What's the new production? What's the flow this year? In national accounting terms, stocks, bonds, mutual funds, and other items whose value is risky are not investments. They fall into the category of savings, not investments. If you purchase stocks, this would be an additional supply of savings, giving someone or a firm access to money now so that they can invest in capital with the intent to increase productivity, right? So it's kind of a roundabout way connected, but that act alone, buying stocks or things like that, that is savings, that is not actual investment. Investment is when the firm or individuals try to add machinery or some kind of capital such as building or equipment or things like that that can increase future productivity. Government expenditures or government consumption and investment is really pretty straightforward. It is our first two categories, our consumption and our investment kind of combined, but whenever the government does those things. So the purchases by local, state, or federal governments is all kind of clumped into here of our government expenditures category, right? So everything kind of fits within this category here of government expenditures. If it's done by the government, we're going to just say government expenditures. So this is our kind of third category here. The fourth category is net exports. And so we want to be careful here. Net exports are equal to exports, so anything we domestically produce, but we sell abroad. So anything that we produce here in our country, but sell somewhere else, that's an export, minus our imports. Imports are anything that were produced somewhere else, but then sold here domestically, sold within our country. So net exports are exports minus imports. Net exports are the amount of goods that we produce here but then sell somewhere else, minus the amount of goods that we buy here that were actually made somewhere else. Now, a lot of people look at this and they say, oh, okay, well, when we're doing the expenditure approach to GDP, imports are subtracted from our GDP. So imports seem to be this negative towards our GDP, or negative towards our production. No, this does not actually mean it's a negative towards our GDP. It's simply the way that we are doing the accounting of our GDP. What we're doing is we're counting all consumption that we make in our personal consumption category. And so if we buy a tennis ball that was made in China, that's going to count towards personal consumption. But then what we have to do is we have to make sure that we subtract that tennis ball in our net exports category as an import, right? Because what we're trying to measure is how many goods did we produce within this country this year? And if we just try and calculate up all of our personal consumption, we're going to have some things that we didn't produce, that we buy, that were produced in other countries. So when we buy a tennis ball from China, we say, oh, okay, well, we have this personal consumption, and that counts towards our expenditures approach. We spent $1 on a tennis ball. Well, we didn't make that production, though, and so it shouldn't really count towards our GDP. So it kind of counts as a positive in our personal consumption, but then a negative within our net exports here because it's an import. And so it's not as though imports actually hurt our GDP. It's that when we calculate them and we account for them in this way, imports are seen as a negative. But we could continually import and import and import from another country, and that is not actually hurting our GDP. It's just how do we measure these things, right? And so this is kind of a common misnomer that you hear, well, imports are bad for GDP. Within the expenditure approach, yes, they are subtracted from GDP, but we also have to understand that they are also a part of just kind of the accounting system that we do here. They are already counted as a positive elsewhere, and then they are subtracted. So net exports is kind of our fourth component here. It is exports minus imports. Exports are domestically produced but sold abroad. Imports are produced abroad and sold domestically. If you take these four components, consumption, investment, government expenditures, and net exports, we can abbreviate these with C, consumption, I, investment, G, government expenditure, plus NX, net exports. If we take these four components together, we have our total expenditures for the year, which is adding up to our total output, or Y, right? So our GDP can be thought of as this total output Y, or C plus I plus G plus NX. Now, every now and then you'll see the equation Y equals C plus I plus G, and then there's no NX. All we're doing when we showcase the equation that way is just saying, okay, well, imagine that we are in a closed economy where we don't have any imports or exports, or imagine that that area is just a wash, that we import just as much as we export, and so we're not going to consider that in. And so domestically, we could just look at a closed economy of Y equals C plus I plus G. But the overall picture is our four components to the expenditure approach to GDP, C plus I plus G plus NX. So later in this class, we're going to relate this to our total or aggregated demand as well. This total, C plus I plus G plus NX, is our combined expenditures for our economy. It helps us to categorize where output is being created, and that means that's where spending is occurring within our economy. And all of this combines together to give us our measurement of GDP, our total output, Y. So to just give a couple of examples, imagine that Aaron goes to the movies and spends $20. How do we calculate this impact on GDP using the expenditure approach? Well, if Aaron goes to the movies and spends $20, consumption has gone up 20. So GDP increases by 20. If we use the expenditure approach and we say Connor purchases 4 lawnmowers for $500 each for his new budding lawn service business, right? What do we do then? Well, this is investment. Connor is investing $500 4 times over in lawnmowers so that he can become more productive on into the future. Investment has thus gone up $2,000. So I has gone up $2,000. Our overall GDP from this has gone up $2,000. And one last example, a little bit more complicated. Imagine that the United States government imports a $100,000 machine from Japan to help pave roads. Government expenditures has gone up $100,000. But net exports has gone down $100,000. So the total GDP change is 0, which makes sense. You should always find that answer first. Have we produced anything within our borders given this kind of setup where the United States government imports something from Japan? No, we haven't produced anything. There's no flow. There's no new production that the United States have done. And so we shouldn't see GDP go up at all from this transaction. And that's what we get. We get G going up 100,000, but NX going down 100,000 for a net total change to GDP of nothing. All right, in this video, we talked about measuring GDP with the expenditures approach, having the categories of consumption, investment, government expenditure, and net exports making up our overall output or measure of GDP. For more on GDP, click the video link here to continue on in this lecture series.